Hello, this is James Kelly, Senior from Kelly Research, Training and Technology, better known as KRTT.com on the internet. Thank you for joining me for our SMO product, or Secondary Markets Outlook. This is where we look at those important financial markets that we didn't have a chance to cover in the Major Market Outlook, the SMO being the sister product to MMO, or Major Market Outlook. And I'm doing this on July 5th. It's about midday in the New York Stock Exchange trading session. The topic on the cover slide is place your bets when you see a volatility uptick. It's particularly important, I've taught this before, when you're holding your own investments and your financial assets, watch out for those volatility changes. When you have a significant uptick and those bars start to get bigger on a chart, it often means that things could be changing. You'll see this with indicators that are very visual and very easy to see, such as Bollinger Bands. So when the Bollinger Bands narrow and then start to expand again, we're naturally seeing a volatility uptick. I've got a lot of topics to cover in this particular SMO. We're going to go into detail on the energy complex, particularly oil and gas. We'll look at copper, the euro, which trades opposite of the dollar, a brief stock market update, and naturally a few bonuses. So I'm excited. We've got lots to cover. Let's get into it. The first thing I want to begin by is a tip, because a number of you are quite interested, I found out, in the commitment of traders. And although I routinely cover the commitment of traders for the stock market, what about commodities or currencies was one recent question. Well, when you're talking about commodities, we're going to look at oil in just a second. The most important thing is that you spend a fair amount of your time on what the producer merchant is doing. And I've got the ICE contract over in Europe. I've got the New York Merc, which are the big ones in oil. You'll see a large open interest. Remember that these are thousands of barrels, as you can see. So we're talking, billions of barrels here on the Merc are trading in the futures market. So what we're seeing here is the people that actually produce. So they are the top line. They are indeed the market makers. They have obviously huge positions. They will be in the market all the time. They have tons of research. They know their industry well. They therefore have insight. They also have insider information, because naturally these are the corporations producing very sophisticated views. They employ sophisticated traders. That's not to say they don't make mistakes that can cost them a lot of money, because everybody makes mistakes. It's not a 100% game when you're trading. But they are not speculators. Remember that the other participants are going to be a lot smaller. They don't have the same stake in it. They often act on behalf of others, and they would normally and frequently be speculators in these markets. So what we see here is that the long positions are both greater than the short positions. So remember that the positive numbers are without a minus sign. The minus sign means selling, but here you can see that they're always going to be hedging their positions because they are in the market by nature. But in this particular case, you will see that their long contracts are greater than their short contracts. In the case over in the ICE, even a little bit greater of a ratio. And we'll talk about that more in just a minute. Now, as I update oil, going back to an old chart, this is about 6 to 7 weeks ago, May 16th, I was getting bullish on oil. And again, we've had this volatility compression here. You'll notice that the little box here that I'm drawing with my cursor is the smallest one compared to all the volatility on this chart. And you can see that we had a real runaway market. This is a very rare condition. I've described what this significance is to you before. It's often called an exponential curve or a parabolic market. And they often have bad endings. We talked about Walt Disney, the stock on the New York Stock Exchange, being in a runaway market recently, that it broke out of the top of the band. And you can see the very, very terrible collapse that it had in the financial crisis. Well, part of that collapse problem was the fact that you had a runaway market. Now, this is a time period that was unique in history when everyone thought the oil was going to run out. We had this theory going around the world called peak oil production, and we are going to go into declining production forever. Well, the world found out that theory put forward by a number of economists was completely false, and you can see the end result, a very, very nasty bear market where people lost all of the profits very, very quickly that perhaps they gained if they didn't get out of it very quickly. Since that time in 2009, after that financial crisis, we've been in sort of a sideways pattern, but we've got a very nice triangle formed, and I was looking for a breakout, and we all know what we do when the prices cross a downward sloping trend line. It's usually a buy signal. So that was back in May. I said, bottom line, I'm becoming more bullish. I'm on bullish alert, but we had to get above 104 here. Again, stop and read these. I don't have time to cover them all. When I update this chart, notice the breakout here starting to show up. And in fact, today oil is up again and frankly hit 102. So the bottom line is oil is looking like it's starting to break out. This is exactly as I predicted. It's also in line with our seasonal cycle. And I've talked about these seasonal cycles a lot for you new subscribers. Again, stop and review these screens. Normally in North America, the crude oil market is highest in the summer and lowest in the winter. And that really relates to driving in North America. Again, in North America, particularly in the United States, the largest consumers in the world. So it's only natural that demand is very, very high and that pushes prices up. So again, what I am simply saying here is I'm still bullish. I'm turning more bullish. It's on time for the seasonal cycle. We also have higher highs and higher lows here. So we got a little bit of a bull market starting up here, I think. And again, we were breaking out from this downward sloping trend line. I'd really like to see above 104. 104 tends to relate to this top back here, and needless to say, we all know about Richard Dennis, or hopefully you do, Richard Dennis and the Turtle, who taught us so much about breakouts, really learning on from the footsteps of Donchian. And of course, Donchian was the great analyst who discovered that breakouts make so much money that the Turtles and Richard Dennis capitalized on, well documented in the book called Market Wizards. So again, I'm bullish. I'm getting more bullish. I'm still waiting there for a breakout above 104 to say, well, we've got an established uptrend. What crude oil prices, here's another bonus, but you always should look at the futures chain. And in this particular case, you'll notice that the closest contract as of yesterday, 101 for the August contract. And yet when we go into 2014, notice how the prices are falling. This is meaning that price and the traders right now are saying that I don't want to pay for future oil. I think it's going to go down in price. Often you'll see this rising. If the prices had been getting higher, you would have said, hey, they believe that prices are absolutely going up. And so you can still see a very bearish attitude. And that doesn't really surprise me too much, but I think it could change very, very quickly. And why aren't the producers selling short? Why are their long positions higher than their short positions, as we just saw in the latest COT? So bottom line here is, if I had to make a bet, who are right? Is it the speculators and the futures traders, or is it going to be the producer merchant? I would say probably the producer merchant knows a lot more about this. And again, it shows up on the chart as we start to see a more bullish chart. As we look at the second big one in the energy complex, natural gas, I'm updating a weekly chart. And again, I don't have time to go into all of this. For you new subscribers, stop and look at this. We usually buy in the fall and sell the winter high in natural gas, because that's again when it's coldest in North America and prices tend to be highest then. And we saw this traditional cycle show up again this year. I was getting a little bit worried. I said that the trend had pulled back. The seasonal cycle, betting on another high, is now risky. And you can see that we've been in this correction here. We've got a new low in CCI. And really what I'm saying is I'm not too happy with this. So I've gone to a yellow background on here to put you on alert. And I'm saying let's go see in the daily chart here if we can find out what's going on a little bit more. Now, just to show you where I was about 6 to 7 weeks ago using the daily chart taken right out of our SMO product on May 10th, I said I'm somewhat bullish for one more potential high, but the risk is increasing. And I said prices must hold near the current level. And part of my rationale there, if you recall, was that this was a 4 wave and we should have one more 5 wave up at least to a double top. And so at the time, we could remain somewhat bullish. We're still in a long-term up channel that clearly has a slope, but I really wanted prices to hold around the 392 level. At the time, we were at 391. And I said if they break 375, it's game over. That would make this not a 4 wave. 4 waves don't retrace usually more than 25 to 38% if they're going to be good. And again, we had a little bit of positive divergence show up here. We had a low and we thought it could round. So it was a bit of a tough call, but the bottom line is I said prices had to hold. Did they hold? Let's update the chart and see what happened. They sure didn't. In fact, prices fell very quickly, and we're down here, by the way, down 22 cents at 369, and this of course is up to date till July 3rd, a couple of days ago, and I hope everybody did have a good Independence Day holiday. I know I sure had a great Canada Day. It's a very short trading week this week, but the bottom line is we've lost 22 cents. You can see that the gas prices have continued to collapse. This is very typical typical of the seasonal cycle. Of course, I was also saying sell natural gas stocks, and the bottom line is not too much is new. I think this is a pretty negative situation. We've now broken out of the long-term channel. As you can see, we've crossed down here. So that's a major break when you break a long-term channel like that. So again, we can no longer be bullish. This is why the background is in pink or red colored. So I'm getting a lot more bearish, but the bull trend speculation, if you want to be a speculator and say, well, this has gone down a lot, we're at the bottom of the channel, we'll rally at least back, well, it's a lot of risk, but my best advice would to be out right now. I think this is too low to sell down here, and so I wouldn't be short at this point anymore, but it's also not confirmed that we're going to go up because we still have this channel going down right now, and we still have a negative CCI pattern. So I would continue exiting those natural gas stocks that we're trying to sell at winter highs. I think as the summer drags on and into the fall, the prices could well trend lower. I want to briefly talk about Dr. Copper, and this is an old chart. We'll explain Dr. Copper terminology in just a minute, but in my past copper update, I was bearish, and I said I didn't see any sign that really the downtrend was over. And this really followed on with our view that we've been in a bear market in commodities for the last year and a half to 2 years. And we've seen copper follow gold, copper following platinum. You can see even that oil really went sideways to nowhere. So the commodities markets overall were very, very bearish in the last couple of years, and this pattern here going sideways looked like a corrective pattern with an overall downtrend. And I tried to show some natural law and some Gann theory on that particular update. But the bottom line is, I said no sign that the downtrend is over, including copper stocks. And the last time we updated this was about March, so quite some time ago, was to stay out. And that was good advice. Copper at the time was $3.44. Recently, copper, as I update this, touched $3. So we've seen that copper trend continue down. Here's a long-term regression channel. But what's happened when I update the chart? Well, the chart now is very, very critical. This is what I call a make or break point. Notice that the A wave and the C wave are now basically equal. This would be a double bottom. If we put it in Elliott terms, this is a flat, and this means that we should start a brand new bull leg at this point. But if it breaks down here, folks, we're in big trouble. In fact, I would say 25 cents minimum once you break that $3 psychological barrier, and that almost happened just a few days ago. So my advice is to wait for this make or break situation to play out. It probably won't take too much longer, but the key here is it's a very dangerous scenario because we've seen platinum get into this exact same formation. Well, what happened? It broke lower. We saw gold get into this. What happened? It broke lower. We have to be very, very careful here. Bottom line is copper has upticked in just a few recent days back to the 317 level. There's a little bit of positive divergence in both the RSI. We may start the uptrend here. We're right down at the bottom of the Bollinger Bands. We're still in this downward sloping channel, though. Really, to turn the long-term trend around, we got to go all the way back to the top of the channel or the top of those Bollinger Bands going down and see some type of significant rally. So I'd be watching for a volatility uptick here. Again, we're at a make or break point. Copper's dangerous. Something must happen. My best advice would be to be out. You would have to have deep pockets and be a pretty big risk taker to want to be in there speculating right now with this type of double bottom pattern until the chart develops. Use the daily if you are a trader for sure, and your hourly charts. Watch your charts because this thing likely is going to make a move fairly soon. Now, I referred to Dr. Copper, and one of the reasons why I like to review copper is many people have talked about this as being a very good leading indicator of a nation's economy, or for that matter, even the global economy. Copper is used literally worldwide, and we all know about the electronics industry and the high-tech industry where copper is plentiful. That's the number one use. But what you probably didn't know is copper is everywhere. There are many uses, in fact hundreds of uses. In fact, your house or the hotel you stayed in recently may even have a copper roof. So remember that copper is a very powerful thing in the global economy, and when copper prices go down, it shows that there isn't demand, and that is why I say copper and commodities are very representative of the real global economy, which frankly have been weakening ever since 2011's peak. And this is why we have a very, very big divergence and some trouble showing up between the divergent asset groups right now. And of course, I'm talking about the stock market going up when commodities go down. Now, both of the stock market and the commodities market usually like the same thing, and that is a strong economy. Stocks do well in strong economies. That's when they make more money, when they sell. And the bottom line is that does not happen. We have a very unusual situation with a bear market in commodities and a bull market in stocks. Just before we talk about stocks, I will briefly review the euro. And of course, this is the big currency opposite to the US dollar in the US dollar index, which trades that big basket of currencies, about 7 of them. So the euro is the big one. We have the yen in there. We talked about that recently. The Canadian dollar we've talked about recently. Those are other currencies in the dollar index. But if you live in the US, you definitely want to pay attention to the euro, because if the euro is in a bear market, the dollar should technically be in a bull market. They have a teeter-totter. They go back and forth and they fight as the world's 2 biggest, most sought-after currencies. The key here is I said back in May that we would probably be in this down bear trend some more, that I didn't think it was over. And we had basically some interesting evidence. It was negative on the CCI at the time. I did say I would become more bullish if we got above 132. And I would say, well, I would get more bearish if I was a trader below 128. And what I was trying to point out is we've been in this sideways trend now a little bit too long. So let's update the chart and see what happened. We closed there back in May about 129.84. Well, guess what? It's gone nowhere. The sideways trend has continued. So as we take a look at this updated chart to July 3rd, we're exactly the same level, and the sideways trend has just extended for the last 6 weeks. But I want to point something out. We had the volatility uptick. Well, before volatility upticks, sometimes it contracts, and it can contract a lot. And it shows up so easily when you use a Bollinger Band on your charts. And here you can see a very narrow Bollinger Band. And folks, you won't find a Bollinger Band this narrow unless you go all the way back to 2006. And you'll see the contraction of a very small Bollinger Band here. What happened? A breakout and a run of a trend. And so we have to be very careful here. We're exactly at the middle line in this long-term regression, which slopes down. And now we've got a contracting Bollinger Band, and we even have a very tentative CCI. The CCI has been on both sides of 0 lately. So this is sort of what I call a make or break situation, much like copper. It's predicting that something is going to happen soon. So again, with these narrow Bollinger Bands, we have to suggest that something is going to happen soon. The US dollar has been in a sideways trend also recently, so the US dollar and the euro may well be getting ready to do some type of significant move. And my advice is bottom line, bigger corrective in the medium trend down is now becoming a lot less certain. The Bollinger Band has me on alert. If we break out, we're likely to see a run at least to the top of the channel here or to the bottom of the channel very immediately. My best advice would probably be to use some breakout points at 132 and 128, about 2 cents either side. And I think you could play another 5-cent move at least, and that would be a very big move for you currency traders out there. Briefly on the stock market, I want to talk about one thing, and that again is to emphasize that currencies and commodities have experienced a lot of weakness and even bear markets in the last 2 years. The truth of the real world economy is what I think shows up in the commodity market right now. And unfortunately, the U.S. Fed and monetary policy has just fueled a massive bull market in stocks and bonds. And I think these are extremely artificial. And I've warned everybody that this is a very high risk situation, that it is a good time to do some thinking and remember to ask those questions about the overvalued bond market. How long can that last? Can the U.S. go it alone in a global slowdown that we've seen so far? What is the actual economic evidence of the U.S.? We've seen a slowdown. We just talked about GDP the other day. Housing, even though it's one of the bright sectors that people talk about recently, it's nowhere near as bright as it was in 2007, 2008. So housing still has a long way to go. Unemployment, well, I think they're going to need over 200,000 in the jobs every month for the next 1 to 2 years to try and get unemployment down to 6% in the state. So there's a lot of definite questions. There's a lot of headwinds facing the U.S. stock market. But despite that, monetary policy keeps on kicking in. And I just want to talk about the news this morning before we look at a chart. Again, I'm not going to read these, but stop and read these. We had a lot of talk out of the ECB and Mario Draghi, again, using jawboning, or a lot of talk and moral suasion, as I call it, to say he was going to print money forever and keep interest rates low. And of course, the European markets rallied yesterday. They did the opposite of what they did the day before. When I updated you just a couple of days ago, we saw all the overnight angst on places like Egypt and China's data and Portugal. And then yesterday, Mario Draghi saves the day, says, don't worry, I'm going to print money. And the same thing, by the way, out of Carney's first meeting over in the UK. So lots of monetary stimulus continued in the UK yesterday and in the Eurozone. And that basically created a rally over there. Well, Wall Street, of course, was closed for Independence Day. So this morning's a bit of a catch-up day. The U.S. avoided all the bad news the other day and manages to catch all the good news, this too being a little bit suspicious. But the bottom line is we also have the Fed tapering. In the jobs numbers being good, the Fed tapering becomes the topic. Everyone said this is what set off the recent correction. And this morning, U.S. government bonds, well, the yields are going up and bond prices are again coming down today as the jobs number came out a little bit good. And everyone said, well, now the Fed is probably going to be on time, on target to start tapering later this year. So this is sort of a bit of a double-edged sword right now. Let's take a look at the stock market chart in real time. Now, I did this capture this morning at about 11:33. That's a short while ago in the New York session. And I want to point out that just in the last day and a half that an important channel break has happened. We've got to have a plan B. Now, I think everybody knows what I say. I've been talking now for months that the U.S. stock market's overvalued. The cycle is very, very tired. We see a lot of problems in the U.S. stock market. The Elliott wave count is very, very tired. A lot of technical overbought issues. The key is we have to be on alert, especially when you take a look at a Dow stock like Walt Disney in a runaway market. There's no value there, and there's quite a lot of danger there. But the key is you have to follow the trend. You can't follow my advice. We always go with what's on the chart. And this is why I say stick to that 921 moving average that I taught you folks about the short-term trends in the market. Stick to your 100-day moving averages for those of you that are investors, or your 90-day moving average, whichever you prefer. But the key being is we always follow what's on the chart, not what we think. And in fact, when you can learn to ignore the news and just trade your mechanical trading systems, chances are you're going to become a lot more profitable. It takes a lot of savvy to ignore all the things happening and just go with the technical chart. But the key is, this is why I teach technical analysis so much. This is why it's the core foundational material at KRTT. So what happened on this chart? Well, here was our short-term trend down, and in fact this we could almost call it a medium-term down, because from back in May at that high of 1687, you can see we regressed this price. We got down to 1559, and we're almost all the way back up at 61.8%. The key this morning is we are well outside the channel to the top. So obviously this down channel doesn't hold. An up channel break to me is a cycle inversion. And I call it a cycle inversion because I've talked about this. Everybody knows that the seasonal cycle of the stock market is down. This is when we have our corrections. The stock market should be weak right now, but it's again doing the opposite. And is it coming from the jawboning or all this talk from Ben Bernanke and the Fed officials and Mario Draghi? It looks a lot like algorithms bought in the other day. Again, we're seeing up days even when the trading volume and the number of down issues exceeds good side. So again, a lot of people say, well, this is the Fed or the U.S. Plant Protection Team protecting the market. So Ben Bernanke tends to get what Ben Bernanke wants right now, and I could be wrong. The summer cycle may have an inversion here this year. My absolute max call is that you can't go above the 61.8%. It sort of just doesn't make any sense if we are in a summer correction. So the market has sold off here now midday. We are really weakening, but the bottom line is you do have to have a plan B. Have a what if. So again, right now we're on an alert for a plan B right now. We may well have a double top this summer and a second seasonal high this year in September, October. And remember, on big money tops in 2000 and 2007, if you go back to the monthly chart I showed the other day, intraday in the MMO. You'll see double tops often follow in September and October before the market finally caves in. That could be happening again this year. So again, follow the trend. Keep your eye on the charts right now. It's a very, very tentative market right now. One quick question about the monthly cycle and the full moon. I don't have time to teach these. I've taught them in the past, but they're major turning points. If you take a look at where the full moon was, very, very close to the major low here. Another full moon back in May 22nd. Again, this relates to lunar trading, which I've taught in the past. So for those of you that are traders, don't throw out your lunar trading aspects that I've taught in the past. I'll be teaching these in the future, so it will be taught again in the future. Again, bottom line on this chart is have a plan B. We've done a channel break to the upside. And here is one last bonus for you in this edition. I want to talk briefly about Zygna, and Zygna was certainly the #1 volume, not just on the NASDAQ, but in the entire USA on July 3rd. And I've talked about this stock in the past. In fact, I talked about it back in February 25th last time, and you might want to go back, those of you that were subscribers to the Week Ahead product, and review all of the things I said about Zygna at that time. Now, not only do we have the biggest volume in the United States on Zygna, this qualifies as a KRTT counter cycle stock. And the reason it does is I've been saying try and keep your stock portfolio in stocks that are cheap. And Zygna qualifies. As you can see, it's not at a major high. It's technically at a major low. Now, this particular stock trades on the NASDAQ, and there's the symbol. It's in the gaming industry. It had a breakout, and you can see this breakout. Now, again, folks, here is this change of trend using the Bollinger Bands. Look how narrow the Bollinger Bands were telling us something big is going to happen. Well, it turned out that this drop here was all about the CEO, and this rally here is all about the new CEO. Now, Zygna's got this hot CEO. They paid $50 million. You can read the news. It's a Microsoft official. A lot of people think this puts the stock in play. So what does the chart say? The chart says today it's trading at 343, a huge volatility breakout. Look at the CCI. Look at the on-balance volume, both suggesting that this is going higher. And for those of you that like these small cap stocks, Zygna right now, very, very cheap still to me. I would definitely say it's a buy. And my immediate target would be back to 403. At 403, it will become a make or break. If it gets above 403, it would be a major breakout. So all in all, with Zygna, again, you look at the chart has the evidence, the trend has the evidence. Right now, I would be bullish on this. Again, this is a chart that most of you that have room in your portfolio for some cheap speculative stocks, would be one that I would take a look at on the buy side. I hope you've enjoyed this update. This has been James Kelly Sr. on July 5th, 2013, and until I talk to you the next time, I wish all of you a very pleasant trading week.